What is up, everybody? Here is your January-ish Prime newsletter market update. Sorry I didn't get this out last week. This last bit of January had a couple different files in escrow that had to get closed up and kind of sucked a lot of my time up. And I didn't get the chance to shoot this video, but wanted to get this out so everybody knows what happened with the December market update here in San Antonio. So go ahead and get through it. The average sales price was $259,601, which was a 7.48% increase from this time last year. Median sales price is looking good at just over $203,000, just under a 7% increase. Total sales just under $2,500, which is up 1.6% from the year before. Average rental price up 2% again to just under $1,400. Employment, the Bureau of Labor Statistics has not gotten me anything new and updated for December, so I got the November stuff. But we're still just sitting over 1.1 million, which is a 2.65 increase year over year. And we gained 7,000 jobs from the previous month, so that's good for us here in San Antonio. Unemployment, we did see a little bit of rise of 0.18% just to 3.04, which is well below the national average, which I think is at 4.1 right now, but it did raise a little bit because you'll see in some later slides that we really dropped down below 3%, which really rarely happens. Month's inventory, just under 3.5, which is a 0.51 decrease from the previous month, which is good, but that is pretty typical in the December timeframe. Everybody wanting to get into those houses and get those loans closed before the Christmas season. I expect here in the next couple of weeks when I get to the January data that the months of inventory will increase like it historically does. Here's the median sales prices over time. So this is where I was saying that median sales prices always tend to spike right around the December timeframe, like you can kind of see right in these couple of years. I'd expect in January to dip down a little bit or kind of level off, but it's moving just like it has in the past. Monthly rents, this is what we're kind of following the same trend. In December, January, February, it kind of stays right down here at the bottom, but I would expect this to kind of drop one more month and then continue to rise as we come into the summer. So if you got into those leases coming up, sign them up for 6 month, 5 month, 4 month, or 18 month. So your leases are always ending around those April, May time frames, because that's when you can always see you get the highest rent. Same thing if you're trying to time those renovations. You want to get them on the market right there in that April, May, June, when all the median sales prices really peak for the year before they start dropping off. 20-year unemployment, this is what I was talking about, where it kind of really dropped off in November and then it rose a little bit in December. But you can see here we've only done that one time before, and that was back in the late 1990s before the dot-com bubble even unemployment rose. Now today the stock market did drop like 4.5%, and it's lost all the gains it had in January. So you can see the stock market's almost down 10% on the year, but that's something I'm going to continue to, or for 10% from its high, I'm going to continue to watch to see if we kind of see that reverberate into the unemployment rates, since we've hit historical lows, and you're hearing a lot about the Fed saying they're worried about interest rates and employment, watching wage growth. So we want to see how that starts to react here in these unemployment rates over time. So it's something we're going to continue to watch every month to see if that starts rolling over into our prices and our rents. The year-over-year appreciation kind of is holding steady. If you've watched these before, this is kind of when our heyday, when real estate really was taking off. A 13, 14, 15 year hitting 10s, 11s, but now in 16 and 17, our highest we've really ever peaked is just over 8, and we've kind of stayed down here in the 6-7%. So your average appreciation on real estate is from 3 to 4% on values over time. So I think we're starting to return back down to the mean after this last real estate recession, when everything was retracting at 6-7% for a few years. So I really think we're kind of tightening down. We're not seeing those big appreciation gains anymore, and we're starting to kind of return back down to the average and mean. But it's something I'm going to continue to watch every single month, because I want to know if we really start dropping and getting down, it consistently stays down here in the 1s and 2s like it had back in April of 2016. So now the favorite part about this is where do we kind of market? Where do we see the most upward pressure on prices in the city for the months of inventory? Where do the buyers want to live? So you can see here we're still under 3 months of inventory if we're under $250,000. And especially if you get under that 200,000, that's 2 months of inventory across the entire San Antonio, New Braunfels MLS on Sabor, which is just crazy. That basically means if no new houses got listed, it would only take 2 months for the buyers to consume every single house that is listed in that price range across the entire city, which this is your entry-level, affordable kind of housing price range right now. So that, if you're in those price ranges, there's a lot of pressure to keep prices going up. Now the balanced market is 6 months inventory, so you can see that even all the way up into over 500,000 or just up to 500,000, we're still below that 6 month average, meaning we're in a seller market and a market that is continuing to see gains month over month and year over year. And so that's something I want to continue to watch too, is to see where do people want to live? Where is the most economic pressure to keep pushing those prices up? Now the best zip codes. This is no surprise to see a lot of these up here under the 250,000, with only one being over 300, which is 78230. But 78251 is a very large zip code over on the northwest side, and there's only 1.47 months of inventory in that zip code with a price of 192 average sales price. So a lot of people are wanting to live in that area. Same thing with 78247, which is over there by 1604 and 281 on the east side. I went back and looked a year ago, and this price was only about 145, 150,000 a year ago, and now we're up almost 200,000 because this price, this demand, this month's of inventory has been so low. People wanting to live in that area, it's really been pushing prices up. So if you're renovating in these areas, something to kind of take into account that your list price might be a little higher by the time you get done with a long rehab. So now the worst zip codes. Some interesting stuff that I started to notice on that, that I'm starting to see some of the 78221, 78228, and 78214, which are very low, which when you look back, there's no month's inventory in the city at those price ranges. And why are these the worst zip codes, and why do they have such high months of inventory? Well, these zip codes never even appeared on the MLS because all three of these are on the south side, south of downtown. A lot of older homes, a lot of homes that needed major repairs that could never qualify for any type of conventional financing. What I'm starting to see is there's more and more houses that are going on the MLS, that are being listed for sale, and they are selling on the MLS for higher prices, meaning investors are starting to move down there and do other things besides owner finance. They're starting to use more conventional means to list and sell their homes, because somebody can now pick up a house and for 30, 40, 50 grand that needs a lot of repairs, renovate it and have enough spread to list it and sell it for 150,000. So it's something that I found interesting, that I'm starting to see it pop up every now and then when I'm doing these. This is the first time I've had 3 zip codes that are historically very low-end style housing appearing in my market reports. But that aside, where you see the rest of these is in the higher price ranges, from the 400s, 500s, all the way into the 600s, with very high months of inventory. Once you start getting into the Stone Oak kind of area with 78257, you get 10 months of inventory of housing. So it's something to keep in mind, because that could translate over into your holding costs. And if you're pulling out a house or $400,000, $500,000 hard money loan, and you got 10 months of inventory, you got a lot of competition. So you really need to make sure you step your game up on your staging and your pictures and your marketing for that house, so you're not one of the people that are taking 10 months to sell with a $400,000 interest payment on a hard money loan. So really take those into account when you're searching your neighborhoods for your renovations, of what's your competition on the market, to how long you might have to sit on the market, and roll that back into your interest payments, because that's coming straight out of your bottom line. Once again, sorry I didn't get this out earlier, but wanted to get something quick out for January, and hope with everything kind of happening right now with the financial markets, it's going to be interesting to see if that does roll over into the real estate markets with our unemployment rates, our months of inventory, our median sales prices. So that's something I'm going to continue to watch, and I hope that you guys continue to tune in and stay informed. If you guys have any questions, always feel free to email me at john@prymehomes.com. Otherwise, we will see you guys next month.